Okay, before we continue, there's something really, really important that I need to tell you about ratios. And that is if you're using two different types of financial instruments, in case of the SPY or the TLT, or if you're using two similar instruments like indexes like the S&P 500 and the Emerging Market ETF, EEM, just because this trend is down doesn't mean that EEM is necessarily going down as well, or the SPX is actually going higher and it's outperforming the EEM. The actuality is that this is a ratio. Remember, they're called ratio spreads, they're ratio charts. So in this case, the S&P 500 actually did outperform the EEM, but it may mean that they're both going down at the same time, and SPX, the S&P 500 index, is only going down slower than the EEM. So it doesn't necessarily mean that it's going up. It is outperforming because it's going down slower. So when I say go long or go short these issues, it just means that you want to look to see which one is outperforming the other one in an uptrending market. So the first thing you need to do is identify what the market is. If the market is trending higher, then you want to look and go long those issues that are outperforming. If the market is going down, then you want to go short those issues that are underperforming. It's a very, very important distinction that you need to make when using ratio charts. Now what I'm going to show you is a way to determine when to go long or short the general market. And the reason why this is such a big secret is because these types of ETFs, the ones I'm going to introduce to you, have only been out now for about a couple of years. And what I'm talking about are short ETFs. Those are ETFs that you short the market with. Now, okay, this is really, really critical. This is no guarantee that you're going to actually make money with the market, but I can tell you the dynamics between the long ETFs and the short ETFs is nothing short of dramatic. This is one secret that the top 1% of the traders have been using since 2006, when many of these short ETFs started to make their appearance. Let me give you an example. Right now we're on a 2-year chart. Let me go back 5 years, and we're going to keep the line chart only because it's easier to identify what's happening between these issues. Let's go to the SPY. Now, the opposite of the SPY, the short ETF for the S&P 500 is the SDS. And now there are many short ETFs. There are one-time ETFs, two-time ETFs, three-time ETFs. And what that means is that they are either double the long ETF or triple the long ETF of the index. And they do that by leveraging derivatives and futures contracts. We're only interested in the one-time short ETFs that are the opposite trading vehicle for the long ETFs for the indexes. So in other words, we want to use the SPY and we want to use the SDS. The SDS is the, let me pull that up for a second, is the short version of the ultra short S&P 500 version of the ETF for the S&P 500. So what we want to do is we want to plot the SPY. Now you can see the SDS in front of you, which has been in a major bear trend since March of 2009, when the market actually hit its bottom after the financial decline, and it's been in an extreme downtrend, hitting $19.29 today. So let's go to the SPY, and you can see pretty much since March of 2009 it's been in an opposite trend. But let's plot the two of them together and see what we can find. Now you can look at this and you say, well, maybe this is a good time to go long, maybe it's not. It's very difficult to tell based on using a single chart. But if you plot one against the other, it's a little bit easier to see where the tops and bottoms are. And let me show you what I mean. What we're going to do is we're going to go over to our chart settings, and we're going to go to left scale, and we're going to add a left price scale chart. And what we're going to add is the SDS, which is the short ETF for the S&P 500. And a very interesting phenomenon starts to take place when we do that. Now we're on a weekly chart. We're going back 5 years. But you'll see something extremely interesting, and that is that there are times in which they cross each other. Almost like an oscillator. You've got a bottoming process, a topping process, a cross, and then a cross again. Take this in for a second. Now, the black line here is the SPY, and the blue line on the left scale is the SDS, which is the short ETF for the S&P 500. And you notice something quite interesting. You'll see this kind of a rounding process when the SPYs were starting this rounding process. The SDS was mimicking the same thing in a bottoming process, and you have a very rounded bottom here, and you have a somewhat jagged top on the SPY. But what it did was it alerted me to the fact that this market was ready to start declining. And because of this rounding bottom, now we're getting back into almost the same situation again. We're starting to see kind of a stabilization in the SDS at the bottom, while we're getting a lot of jagged tops on the SPY on the right.